Corporate Finance Presentation, Corporate Securities. Get ready, it's time to take your chance with corporate finance. Corporate securities include corporate bonds, preferred stock, and common stock. The corporate bonds are a debt instrument with a fixed life, meaning it has a maturity, it has an end date. It will be repaid at that maturity date. So it's going to be similar to like a loan type of situation, but it's a bond. It's another kind of debt instrument where you have the financing of it typically being paid with the interest and then the principal being paid back at the maturity date. The corporations often replace existing bonds with new bonds as bonds become due. So in other words, as the maturity date comes due, then oftentimes if the financing is needed at that point, new bonds will be issued in order to pay off the old bonds and continue the financing process. We also have the preferred stock and the common stock. Of these two, the common stock is typically what we think of on the equity side of things. The preferred stock is a little bit in the middle between the bonds and the common stock because you don't have that same voting capacity, so it's not really thought of as basically ownership in the same sense as the common stock. It's similar to debt in that you're basically having a priority about the amount of payments that you're going to get, meaning you're going to typically get the dividends sooner, but usually the dividends have a cap on it, and any dividends above and beyond that point then would be going to the common stock. So it's because there's not going to have any tax impact, it's usually going to be one of the least used components for the financing. So this is generally the least used in part because the dividend is not tax deductible. So in other words, when you're thinking about the bond financing, one of the things that makes debt financing attractive is the fact that the interest that you're paying in order to finance, although that's bad, you get a tax impact, which kind of lessens the amount of the cost of the financing. On the preferred stock, you're basically paying the preferred dividends, which is similar to a somewhat fixed amount depending on the terms of the preferred stock, although there's no end date. There's no fixed maturity date as you have with the bonds, but you're still paying somewhat of a fixed type amount, and you're not getting the tax benefit is what we're saying here. So that's why the bonds can be somewhat more attractive. Notice the taxes do have an impact. They often complicate things. Then we have the equity side of things, or what we would normally think of as the primary component of the equity side of things, that being the common stock, because of course when we issue the common stock, we're issuing in essence ownership or a claim basically to the equity portion, and we have the voting portion with regards to the common stock as well. So company will sell stock when they want equity capital. So when they want equity capital, they need to generate capital, and they want it through equity, they can issue the common stock. It could be an initial public offering, an IPO, or secondary offering. So that means the IPO is the initial offering on a public exchange, most likely. That's going to be the initial offering, but you could have the company making secondary offerings as well. Remember that you do need to keep distinct in your mind the idea of the offering coming from the company that is issuing stocks and the money going to the company versus the secondary market, and that's where most of us do our individual type of trading, in which you have two owners who are simply trading amongst themselves rather than the business issuing the stock. So when the business is trying to generate capital, then they are the ones that are issuing the stock, and they are the ones that are getting paid through the issuance on the primary market. Then we could also have treasury stock, is when a company purchases its own stock. So it's possible that the company then goes into the secondary market, buys its own stock back after it had been issued at some prior point in time. And then, of course, they may sell their own, treasury stock. They might hold on to it and sell it for various types of reasons that we won't get into at this point. And there's no maturity date on the common stock, of course, so there's no endpoint as we have with the bonds. So when we think about the options, of course, with the financing between bonds and with the stocks, we have these differences with regards to the maturity date, the interest that will be involved, the tax impact that will be involved with the interest on the bonds versus on the capital stock, where we don't have that tax impact because it's going to be coming out of equity. We have the internal sources of funds versus the external sources of funds. So you might be saying, why doesn't the company pay for what it does through the generation of profits? The internal source of funds being profitability. If the company is doing well, they should be generating the profit, using that profit to finance their operations. And oftentimes that could be the case, but if the company is starting out, then typically they may need some additional capital in order to invest. If they want to grow faster, they might need that initial capital to invest, or if they want to expand, they often need the initial capital. They might also have then the dividends that are being paid out. So when you're thinking about profitability, how much commitment is there from the company to take that profit and pay it back to the shareholders in the form of dividends, and how much of it is being kept in order to finance future operations and possibly growth. We also have the retained earnings, which is in essence profits. It's the profits that have been generated in the past, which have not yet been used in order to pay out the dividends. So we got the financing through the profits over time, the retained earnings, and then the depreciation tax shield, which is resulting from the depreciation deductions that could give us more benefit with regards to cash flow as well. So these are going to be factors in terms of our capital structure, the cash flow that we might need, and have an impact on the strategies we might take to get the cash we need to do the things we want to do to generate revenue.